You remember the last couple of years, right? It's like someone just flipped a switch. All of a sudden, the price of gas, groceries, your rent, everything just started shooting up, like at this crazy pace. It really felt like the whole economy had caught a fever, and you could definitely feel the heat in your wallet. Okay, so let's actually put a number to that fever. When the Federal Reserve, America's central bank, finally decided it was time to step in, back in March 2022, this was the number they were looking at: 6.77%. And just to be super clear, that is the highest inflation rate we've seen at the start of a rate hike cycle in more than 35 years. So the patient's temperature wasn't just a little high, it was blazing. We were in the danger zone. And that right there sets up the big mystery we're going to try to unravel. What in the world caused this economic fever? And maybe even more important, is the aggressive shock and awe cure the Fed is using actually more dangerous than the disease it's trying to fight? All right, let's get into it. Okay, first things first. We have to diagnose the problem. To really get what the Fed is doing, you have to understand what they think they're up against. And believe me, on this point, economists are pretty much split right down the middle into two big camps.
So, on one side, you have Theory 1. The idea here is that the economy was just overheating. You had massive government stimulus checks, people had a ton of pent-up demand from being stuck inside, and it all created that classic textbook scenario: way too much money chasing way too few goods. That's going to push prices up. But then there's Theory 2, which says, hold on, it's not that simple. This camp points to a perfect storm of really unique shocks. The pandemic shutting down factories, global supply chains just completely snapping, and then the war in Ukraine messing with energy and food. This theory suggests that's the real culprit, maybe even with some companies taking advantage of the chaos to pump up their profits. So it doesn't really matter which of those two theories you subscribe to. The doctor in our story, the Federal Reserve, saw that fever spiking, and they reached for their most powerful medicine: jacking up interest rates. The logic is pretty straightforward, right? You make it more expensive for people and businesses to borrow money, which should, in theory, cool down spending and get demand back in line with supply. But, and this is a really big but, the way they administered this medicine was anything but gentle. This wasn't a gradual treatment. What the Fed did, well, it was basically a form of economic shock therapy. And wow, this chart really tells the story. Just look at it. See the other times the Fed raised rates? They look like these gentle, rolling hills, gradual climbs that took place over years. Now look at 2022. That's not a hill. That is a straight-up cliff. It's a near-vertical climb of over 2 percentage points in just 6 months. This wasn't like turning down the thermostat a little bit. This was like blasting the entire room with liquid nitrogen to cool it down, and fast. Now, you can't just blast the economy with a cure that strong and not expect some pretty serious side effects. In the very first place, most of us felt those side effects right in our investment portfolios. If you've got a 401k, an IRA, any kind of brokerage account, you felt this one almost instantly. See, it all comes down to a fundamental shift in the math for investors. Just think about it. When interest rates are super low, that safe government bond doesn't pay you much, so you're more willing to take a risk on stocks for a bigger return. But when the Fed jacks up rates, suddenly that boring, risk-free bond is offering a pretty decent payout. So why would you gamble on a company's potential future profits when you can get a solid, guaranteed return right now? That simple change in thinking, well, it completely upends the stock market. And what's really interesting is how this affects different kinds of stocks. On one side, you've got your growth stocks. A lot of big tech companies fall into this bucket. Their whole valuation is built on the promise of huge profits way down the road. Well, when interest rates go up, the value of that far-off promise gets discounted, and it becomes worth a lot less today. But then you have value stocks. These are more established companies that are making solid cash right now. They're not immune, for sure, but they tend to hold up better because their value is based on the here and now, not some dream of the future. Okay, so the ripples didn't just stop with the stock market. Nope, the Fed's big move sent a shockwave that was felt all around the world. And it all comes down to the value of one thing: the good old US dollar. It really starts with a pretty basic economic principle. When a country raises its interest rates, it's like putting up a giant neon sign that says, "Great returns here." Money from all over the world starts to flow in, and that makes the country's currency stronger. And here's exactly how that chain reaction plays out. So step 1, the Fed raises rates. Suddenly, U.S. investments are paying out more. Step 2,
An investor, maybe in Europe or Asia, sees this and thinks, hey, I can make more money in the US than I can at home. Step 3. But to buy those American investments, what do they need first? They need US dollars. So step 4, all this new demand from investors around the globe wanting to buy dollars, well, it pushes the value of the dollar way up compared to other currencies. A super strong dollar was a direct result of the Fed's aggressive plan.
So we've talked about the immediate side effects on your portfolio and the dollar, but this really brings us to what might be the single biggest takeaway from all of this. What we're seeing, it might not just be a temporary thing. A lot of evidence suggests this is a fundamental long-term shift, a real regime change. That whole era of ultra-cheap, almost free money that we got used to for the last decade, yeah, that looks like it's over.
And to really wrap your head around this shift, we got to talk about a concept economists are all buzzing about right now. It's called R-star. Now, don't let the name scare you off. It's not that complicated. Just think of it like the economy's Goldilocks interest rate. Not too hot that it causes inflation, not too cold that it causes a recession. It's just right. And for a long, long time, the thinking was that this just right rate was basically zero. But now, well, there's a growing belief that the economy's new just right point is actually a whole lot higher than we thought.
And this slide right here, this is the perfect before and after picture of that change. On the left, you've got the world we used to live in, from about 2009 to 2019. Money was super cheap, basically free, and it flowed like water. On the right, well, that's our new normal. Capital is just more expensive now. We seem to have entered a whole new era where interest rates are probably going to stay higher for longer. The money that fuels everything from business expansion to our own car loans.
So, what does all this mean for you and me? I mean, how are we supposed to navigate this totally new economic landscape where it feels like all the old rules have been thrown out the window? All right, as we all try to figure this out, here are the 4 big things you really need to be watching. First up is the Fed's Balancing Act. It's a high-wire act, really. Can they keep inflation down without crashing the economy? Second, remember the lag effect. The medicine they gave the economy back in 2022, it's still working its way through the system. The full impact hasn't even hit yet. Third, and this is the big one for all of us, is the cost of capital. Higher borrowing costs are the new reality, period. And finally, keep an eye on those global ripples, because what the Fed does in DC absolutely continues to shake up economies all over the world. And that leaves us with one last really big question to think about. It looks like the Fed's radical cure is working. The economic fever seems to be breaking. But as we all start to settle into this new normal, this higher cost world, you have to wonder, are the long-term side effects of this cure going to create a whole new kind of economic sickness that we'll have to deal with down the road? The treatment is happening right now, but what the patient will look like when it's all over, well, that's still anyone's guess.